Good morning, gang. Happy Friday. Finally, huh? All right. So I figure a lot of you guys, well, I know a lot of you guys did because I got tons of emails yesterday, saw that the 10-year Treasury went over 2%. And I want to explain to everybody why that's crucial. I mean, I've talked about it before, but now that we're there, kind of explain in detail to you. Okay. Since the beginning of the year, the 10-year Treasury has risen 34%. Okay, we started the year at about 1.75. We're now at just over 2.005 or something like that as I'm recording this at about 6 in the morning. Where that gets scary is you also got to compare it to the 2-year. And I'm going to get wonky again for you guys here. The 2-year has doubled, more than doubled, okay? And so what you're having is a flattening of the yield curve, which, if you think about this real quick, think about buying a CD, for example, okay? Something that more people understand. You buy a short-term CD, it's got a lower interest rate than a long-term CD. You're taking more risk tying up your money for longer with a longer-term CD, so you get paid more. Well, the Treasury bonds work the same way. The problem is we're starting to get close to parity. Why would you tie up your money for 10 years when you're getting paid the same as if you tied up your money for 2 years? That's what's going on with, with the Treasury bonds. Now, y'all hear the term inverted yield curve. Okay, and again, same thing, 10-year, 2-year. Inverted yield curve means this happens, where you're actually getting paid more for a short-term bond than you are for a longer-term bond. That's called an inverted yield curve. And the scary part about that is the yield curve has inverted before every recession since 1955. Usually somewhere between 6 months and 2 years later, we wind up in a recession. What does that mean we are heading toward? Like the government needs another issue, another problem to deal with. Oh, and guess what? This one would be created by them too, okay? With all the stimulus checks and everything of the sort. I mean, last 2 years, under both presidents, don't get me wrong, this isn't just a Biden debacle, this is also Trump's. Oh, we've got to send out these $2,000 checks, these $1,600 checks, whatever the hell they all were, to help the American public. Now, mind you this, the government doesn't make money, okay? I mean, they're a nonprofit organization, if you want to say that, okay? They have no product they sell or anything like that. So the only way they can give you money is by taking it from someone else. And as per normal, what the government has always done is given us the money now and taken it from us in the future. Now, Rudy over at the Alaska Prepper did a piece yesterday saying that inflation right now was going to cost the average household $250 a month this year. Extrapolate that out, that's $3,000, okay? So right there, you are paying back your stimulus money just in the cost of inflation. And that's where we are now. After CPI numbers came out yesterday at, 7.5%, where they expected 7.3. So inflation's running hotter than the Fed expected. Oops. Okay. So now you're getting all the talk of the Fed raising rates and as to stop inflation. There's good and bad to that, depending on which side of the fence you sit on. If you are a borrower, that's a bad thing. If you are a saver, that's potentially a good thing. Now, the Fed only moves the federal funds rate. That's it, okay? They don't determine bond rates or anything like that directly. The federal funds rate is the amount of interest charged for banks to borrow money overnight. Okay, that's it. Well, what's happening with this yield curve is, and the rate hikes, is going to make the bank borrowing more expensive to the bank, which means the bank is going to raise rates to the end user, you, on anything that you borrow. Credit cards, car payments, mortgages, etc., etc. Car payments and mortgages are directly tied to the 10-year note. That's why 2% is so important, or why the 10-year at 2% is so important. Sorry, it's early. Try to talk about this at 6 in the morning. It's like, woo. So this is where it gets scary, because now there's rumors that the Fed could have an emergency hearing today or Monday. There's about a 30% chance of it, I guess, that they could jump rates early before the next Fed meeting in March. That would send the markets in turmoil. Now, we already saw what happened yesterday with just two things happening. I mean, the Dow was down over 500 points yesterday, and I told you guys a crash is coming. This may be the beginning. The 2% level I told you guys a long time ago was when the oh crap moment starts. We crossed 2%, the Dow's down 500 points. The Fed comes out and says, we're going to raise 50 basis points, which is 0.5%, guys. A basis point is 1/100%. Okay. And so that freaked out the bond market, or that freaked out the stock market too, and people started selling. What's going on as we speak right now? Okay, here it is. It's 10 after 6. I'm looking, and the Dow futures are down 144 points right now. Okay, who knows where they go into the morning. If the Fed raises rates today, expect another bloodbath. Okay. Now, why would the Fed want to raise rates? This is the big question. We've talked many times about inflation, okay? And you have money supply and product supply, okay? And we have inflation when there's more money in the market than there is product. We all know that right now. Everybody got pumped, all sorts of stimulus checks, all sorts of bonus unemployment checks, and they pumped a lot of money into the economy. And we all said 2 years ago, this is going to cause inflation. At the same time, we had the supply chain crash. We have all the weather issues. We have the food problems, et cetera, et cetera, et cetera. So this is getting more and more spread apart. So by the Fed raising rates, what they're trying to do is reduce the money supply, make credit less available to businesses, people, et cetera, et cetera, et cetera. The banks will tighten. Okay? They will say, okay, you know what, we're not taking the risk. Joe was a good risk when we were making 1% off of him, but Joe's not as much of a good risk when we're only making 0.5% off him, so we're not going to loan him the money. So that squeezes the money supply. But that's only half the equation. The fact that supply, okay, the Fed has no control over supply. The Fed can't say, gee, you know what, we're going to make more widgets. Okay, that they have no control over that. So they're only working with one side here. And if they lower this and supply continues to go down, inflation doesn't move. And that's the problem that we have right now. Supply isn't stable. It's not the money issue per se, it's supply. And that is why the government is in so much trouble in the first place corralling this. Because they can't control how much food is produced, how much stuff comes over from China. Truckers not delivering whatever would be, you know, because they're on strike or they're on protest or whatever would be. This is where it gets crazy. This is why it's so important right now to have bills paid off as best you can, guys. I know nobody's going to write a check to pay off their mortgage right now, but, you know, don't be putting stuff on credit cards. Don't be taking out new loans. And everybody's going to say, well, do it now before the rates go up. It's only going to be more expensive later. Yeah, okay. But anything that's got a variable rate interest, like your credit card, the rates are going up anyway, okay? You don't need, this is the last type of time you need to be in debt, okay, is when the Fed is got their hand, when the Fed is handcuffed. So, again, it comes back to get your food, get whatever supplies, okay, whether it's medical, whether it's ammunition, whether it's food, whether it's power, security, you name it. Get whatever you can right now, because it's going to be harder to get the further we go through the year. Analysts expected us to see 2% on the 10-year by the end of the year. Guys, it's the 11th of February. Okay, that last time I checked, that ain't close to Christmas. Not at least looking forward. Get what you can now, because things are going to go extremely higher from here, prices wise. Okay, oil is over $90 a barrel. There's still, I heard talk yesterday, there was one analyst saying we could potentially see $250 barrel of oil. I still think we see $150 barrel of oil, okay? Think about what you would pay in gas right now and add 2/3 to it. That's where we are right now. So if you're paying $3 a gallon of gas right now, which I think any of us be thrilled with, that'll go to $5. Figure out whatever else you want. Your utility costs, same thing. Your food costs, your dog food, your lumber, whatever. Everything is going to get way, way more expensive by summer. Please, please, please put anything and everything you can away now. Do not do it on credit under any means. You are going to get crushed if you do. But that's what's going on with the 2-year. And now when the government has to pay more interest, why do yields go up? Okay, and I've told you before, there's an inverse relationship between yields and prices of bonds. Yields go up when the bond prices go down. That means nobody wants to buy the bonds. That means that nobody wants to buy U.S. government debt, guys. If nobody wants to buy U.S. government debt, that means the U.S. government has no money to spend. They can't sell a bond, so they have cash. Now you start looking at the fact where the government goes, holy crap, what do we do? That's the situation we're in right now. That's how handcuffed all this mismanagement by both sides of COVID has now destroyed the economy. It is, they may say, oh, it's over, we're coming out of it. Yes, okay, that's right here. Gee, we stopped the vaccine, vaccine mandates and everything like that. It's over. No, now we get to deal with the cause and effect, okay? Not only do elections have consequences, but decisions have consequences. And they can't think past here. We can. Pinball out.